Hey, this is Justin with DayTradeTheMarkets.com, and in this video I want to talk about what really moves the market and how you can see it in real time. And specifically I want to talk about a tool that I think you're going to fall in love with called relative aggression bars, and give you some examples of why they work, how you can use them to help your trading as well. So just to start out, let's think about the logic. As traders, obviously, if the market goes in our favor, we make money, and if it goes against us, we lose money. So therefore, it makes sense, at least in my opinion, that if we can get rid of any unnecessary distraction and really get right to the heart of what truly moves the market, that's going to obviously give us an advantage. And therefore, the question is, what does make price go up or down? And the answer is that the market only moves, literally only moves, if one side, either buyers or sellers, collectively is more aggressive than the other side. And there's a misconception. Sometimes people think, well, the market went up because there were more buyers than sellers, or it went down because there were more sellers than buyers. And that is not true by definition, because we know that every time one contract is bought, there has to be one that was sold. Or every time 100 shares were bought, 100 shares were sold. So it's not about more buyers than sellers. It's about buyers or sellers collectively being more aggressive. So if, for example, buyers are more aggressive, price is going to go up. And conversely, if sellers are more aggressive, price is going to go down. And I like to illustrate this sometimes using a kind of real world example, something we've all done, which is buy a car or buy some item like this. And let's just say, for example, that there is a seller who is asking $20,000 for a car, and that a buyer only wants to pay $19,000. Okay, so that's our scenario in this hypothetical case. Now, I realize in real life that probably you're going to meet in the middle at 19.5 and call it a day, and everyone moves along happily. But for the sake of this illustration, let's just assume that the car can only be sold for either 19,000 or 20,000. It has to be around $1,000 number. Okay, so let's talk about scenario one. What happens in this illustration if neither the buyer nor the seller is willing to budge on price? The buyer's not willing to come up, and the seller's not willing to come down. Well, in this case, there's no transaction. Both parties are passive. There's no price movement. I know that, so if we think about this one car on this one day as a de facto market, in this case, there's no transaction. The market price does not move because neither buyer nor seller was willing to be aggressive. However, what would happen if the buyer really needs a car, or feels that, it's still a good deal, or whatever the case may be? If that were the case, then the buyer is going to be more aggressive so that he doesn't miss out. He's going to pay up to what the seller was asking at $20,000. And in this case, our little, one car on one day market, in this case, the price would have moved up because the buyer was more aggressive. Okay. Now, conversely, what would happen? Think about this. If the seller really didn't want to miss out, the seller was worried that another better offer wasn't going to come down, come soon, or the seller really needed the money, whatever the case may be. In this case, the seller has to get more aggressive and actually be willing to accept down to the offering price of $19,000. So again, I know it's just one car, one day. That's our quote market for this example. But in this case, because the seller was more aggressive, the price has moved down. Okay. Now, the same principle applies to the financial markets. So again, we could be talking about a negotiation for one car, or we could be talking about the electronic markets of today, where hundreds and thousands of contracts are being bought and sold per minute. Well, again, same principle applies. If buyers are collectively more aggressive, price is going up, and if sellers are collectively more aggressive, price is going to go down. So logically speaking, if it is aggression that causes price to move, then it certainly stands to reason that if you can identify and if you're able to see that aggression in real time, that you're going to be able to read the market more clearly, that you're going to be able to make better trading decisions, and ultimately better trading decisions lead to better trading results. And that's obviously a great goal, and that's why we developed this tool called relative aggression bars to do that exact detail. So briefly, let's talk about what these relative aggression bars are. What they are, they're telling you in real time whether buyers or sellers, either side, is more aggressive at any given moment in time. Okay? But not only that, they're telling you the degree of the buying or selling aggression. Is it moderate, which we call level 1? Is it strong, which we call level 2? Or is it extreme, which we call level 3? And knowing that gives you a very good real-time roadmap for what's going on under the surface of the market. We know that if, especially speaking about these level 2s and especially level 3s, if one of these comes onto your screen, we know you need to pay attention. Something major is happening in the market. It's not just the run-of-the-mill noise of the market, but there's some strong buying or selling that is coming into the market at that exact moment in time. And what I like about these especially is that these are not lagging technical indicators that are telling you what happened 20 bars ago. It's not just price action either. It's aggression. It's getting under the surface of the market. If you think about this image here on the left, think about that like it's a price chart. We can, in this case, it's a highway. We can look down and see cars are going north or south, slowing down, speeding up, turning right, turning left, whatever the case may be. We can see cars moving. But what would be nice, ideally, is if we could see what's causing those cars to do what they're doing, okay? What's causing price to move. In other words, if we could see under the surface and see, is the gas pedal being pushed down? And not only is it being pushed down, but is it being, is the pedal to the metal, so to speak, or is it being light, or is the car lightly accelerating? We have a very good idea what's going to happen on our road. Same thing with, we also have a tool called deceleration, which is equivalent to a brake pedal. And is the brake pedal being slammed, or are we just kind of tapping the brake? But the bottom line is that it's aggression that leads price. So if we can see the aggression as it's happening, it's going to give us a much better view, or a much better edge in terms of what is likely to happen right now and right next in the market itself. Now, in terms of how you can use these, really the options are endless. I want to go through a few examples of these, how you can use this tool. First and foremost, it's telling you when something important is happening, okay? In other words, when you need to pay attention versus when things are just noise. So in this example, you could see some strong buying coming in, and then we just see a bunch of gray bars and level 1 bars. It's a choppy market. There's not a lot of buying aggression or selling aggression. It's mainly just noise. You can see, though, a little bit later on, some strong sellers start to come into the market and things start to change. So again, pay attention when you see a level 2 or a level 3 bar. When you don't, we know that it's pretty much just noise. So it's telling you when something important is happening. That's one way to use it. Another way is to help you stay on the right side of the market, or you could say stay away from the wrong side of the market. And really just doing nothing more than avoiding being on the wrong side of the market more often, you'll be amazed at what that will do to your P&L, just that alone. So in this example, you can see here early on, extreme selling and strong selling is coming in. Well, what does that mean? That means that we certainly don't want to be fighting that. We don't want to try to be a hero and try to be buying against that. We want to either go with that or be standing aside. Now you could see that this is our first sign of selling failing up here and buying start to come in. That's giving us a clue that maybe, it doesn't guarantee that buyers are coming in, but we know that the market's at least gone a little bit to a two-sided, where buyers are at least in play. And then you could see we start to get some follow through on the buying, and then more strong buying, extreme buying comes in. You can see the tide is starting to turn, and then over here you can see the buyers have just completely taken over. So again, you can see when we're in a vertical mode, when we're in pure seller control versus when both sides are kind of in play, versus when buyers are in complete control. And that's telling you when buyers are in complete control, you better not try to go short against that until something changes, and definitely be looking for long opportunities. And when sellers are in full control, don't try to be going long against that, and certainly be looking for selling opportunities. Okay, so again, just another way of looking at it. Another good purpose for these is to look at these as determining a true breakout versus kind of a head fake. And you could see that if, here's our low of the day at that point. When we first break below, it doesn't do it on any kind of aggression. Nothing there yet. Another test right here. Nothing there yet. Here we break below on a level 3 selling aggression. Does that mean that every single time there's a level 3 on the low of the day, it's going to be a huge move below? No, not every single time, but it sure gives you a much better odds of that happening, and you're very rarely going to see a strong vertical move that doesn't start with a level 3 bar. Okay, so they're a very good clue for when the market is breaking out and truly going into a vertical phase. Another way that you can use this is by looking at, or if you use predetermined areas of support and resistance, or supply and demand, or whatever you want to call it, if you're looking at a specific area to potentially be a buyer, potentially being a seller, I mean, you could certainly just throw a limit order in there and hope that the train comes to a stop before it hits you, so to speak. But a little bit more intelligent way to do that is to wait for actual evidence, and you can kind of see under the surface where here's our area that we're looking to for potential support. Are we seeing it? Well, we're kind of grinding lower into here, no sign of that stopping. Oh, here we made a new low by a couple ticks, and buyers stepped in a big way. It's giving us a lot better odds that this area of support really will hold, and it's a good time to be a buyer. So I hope you kind of time your entry if you like to kind of judge key areas of support or resistance. Another way, and this is a very, very powerful way that you can use these aggression bars, is to help you stay in trades longer or to bail out of a bad trade a little bit quicker. So, for example, and I'll just talk about it in this case. For example, let's say that we got long right in here. And what happens a lot of times, and we've all been through this, is we're into a trade and it's moving, and part of us wants to lock it in, and that makes sense. Don't get me wrong, but it would be ideal if we were able to kind of sit through the chop here, the wiggles, if you will, and know that I'm not comfortable with the way it's going back and forth, but I'm not seeing any selling coming into the market. In other words, the reason I got into the trade, which is extreme buying on a breakout, for example, nothing's really changed. Buyers are still in control. There's no sign of selling. If I can just kind of sit through this and wait until something changes, I mean, who knows? Maybe it changes right here. Maybe we ride this up for 10 more points. We don't know, but that's the key. You can stay in the trade until the evidence actually changes, and that's an example right here where selling starts to come in. Well, now we want to think about getting out of the trade. Okay, so hopefully that makes sense as well. And again, I've just shown a small sample of some of the ways that you can use relative aggression bars. It's really a pretty open-ended tool that the ultimate goal of it is to help you see the market in real time much more clearly so that you can make better real-time trading decisions. Better trading decisions obviously lead to better trading results. But I do want to tell you about one other thing, is that these aggression bars play a very major role in developing what I call boxes or box theory. And the boxes are going to really help you make sense of the market and stay on the right side of things and really kind of drill down and make much better sense, give yourself a much better edge when you're trading. The boxes then lead to trade setups. The trade setups can be scored. And so you put all these things together, the aggression bars, which lead to boxes, which lead to setups, which lead to scoring, which leads to, avoiding bad trades, getting into better trades, really increasing your edge. That's one of the key components of these aggression bars. So we'll talk more about the boxes and trade setups and scoring trades in other videos, but I just wanted to touch on these aggression bars. I think that you will love them. I've certainly obviously I've been using them for a long time, and I'm biased, but I literally can't imagine trading without aggression bars at this time, at this point. And we hear that a lot from people as well. So hopefully that made sense. If you have any questions about aggression bars, don't hesitate to ask. All right, thanks so much. Take care.